see you.
Same here, same here. الله يخليك تسلم.
We hope to
Looking
see you
forward
face
to
to
this
face
session.
sometime soon, huh?
Inshallah, inshallah, absolutely.
Inshallah. So I think we should start. Hello everyone. Let me welcome you all to our webinar, first webinar for 2023. We are very happy to do this webinar jointly with Independent Audit Limited. Actually, we have Richard, who is the CEO, we have been partners together for the last few years in the area of board evaluations. Thank you, Richard, for your partnership, and thank you for being here with us. So today the topic will be it's about ESG and the role of the boards in this. And the reason why we thought about this this topic, in fact, is we have been doing a lot of board evaluations in the last couple of years, and we try to assess the areas in which boards feel that they need to do a little bit more. It always strikes us that it comes always as one of the top areas that boards feel that they are not doing enough is the area of ESG and sustainability in general. And boards start to ask us the question of, where do we start and why that's important for us, how this will make a difference to us, and so on. So we thought of having this webinar to try to very quickly get the key concepts and try to tell boards of directors, if you would like to start the journey of sustainability and ESG, that's what you can do just to start to kick off the process if you like. So I'm really very happy today that I have Richard Sheed with me. He is the CEO or the director of Independent Audit Limited. He has a brief presentation, but please, meanwhile, if you have any questions or comments, please put it on the in writing so that we can see your questions and we can address them. And we'll try to address all the questions and comments that will come from you. Thank you so much for being here. It's really, we value your presence, and we hope that you will get the best out of this 1 hour. Richard, I hand over to you, please.
Very good. Thank you, Ashraf, and thank you for inviting us to participate this morning. Independent Audit, we're one of the leading companies specializing in board evaluation, mainly in the UK, but not only. And so we get to see a lot of how boards are approaching ESG. As you all know, this has become much more of a hot topic over the last 2 years. And particularly in UK boardrooms, there's a very big awareness of the need for boards to really start focusing on the ESG agenda, partly, of course, because there's been a lot of political pressure, other stakeholder pressure, a lot of attention in the media, partly because the investor community...
If I can ask everyone, please mute yourselves. Be muted, please, so that you don't interrupt. Thank you, Richard. Sorry for this.
I was just saying, partly political pressure from other stakeholders, but also particularly from the investor community, who are now really starting to look at how companies are approaching ESG. And also the regulators, particularly in the financial services sector, are expecting regulated entities to have a very clear approach to ESG being led by the board. So it's become a very hot area. So that does not mean to say that UK boards have really solved this problem. They're all still very much learning.
Richard, you are muted. Can you unmute yourself, please?
Wait, hold on.
Yeah, go ahead.
Can you see can you still see the presentation? Okay. Yeah. Okay. So I've got what I'm going to do is just walk you through what we think are 10 key steps that a board should be taking. Hopefully this is very practical. What Hokama will be doing after this is sharing with you a version of this which gives you more of my comments, So the actual one I show you now will be quite brief, but don't worry about taking too many notes because you will get some information later. But the first step a board really needs to do, and I'm going to list these 10, so I'm going to be working through these 10 key steps. The first one is to really think through what are the strategic implications of ESG. Because, and this takes time, boards are not spending enough time working with management to really think through all of the implications. I'm going to, on this next slide, just show you how far-reaching ESG can actually be across not only strategy, but also operations. This is not a complete list, and I'm not going to walk through the whole list, but you can see this ranges across many different aspects, from organizational culture, health and safety, external communications, investor relations, compliance, ethics, policies, human resources, welfare. I'm not going to say any more than that, but the message here is, if ESG is done thoroughly and boards really working with management, what the actual implications are, it reaches into every corner of the organization. And that is where a lot of boards and management teams are still struggling. They're still trying to work out what this actually means. So it is something that has to really needs a lot of time to think it through. But of course, before you can do that, what you really need to do is make sure that everybody in the organization, well, at least the board and the management teams, have a common understanding of what ESG actually means. I mean, personally, I do not find it a very useful acronym, an acronym being where you take the three letters from environmental, social, and governance, because these things, first of all, are very different. But when you look at them, it means that you're looking at so many different things, as we've just said, that it's quite difficult to actually work out what you're actually talking about in ESG. So it's very important, early step, and I put it step 2, but it's only right at the beginning, that the board and management really making sure they have a common language when they're talking about ESG. Because what we're seeing in practice is that it's becoming used just as a way of talking about environmental, and the social and the governance parts of it, which are in some respects more difficult, are actually being neglected and not considered. So ESG is now just being used as an expression to refer to the environmental strategy. And of course, it shouldn't be that. Yeah. So what you need to be doing, what the board needs to be doing with management, is really looking at all of the 3 separate components. What are all the different issues from an environmental viewpoint, and what are management doing across those, and how is that affecting the operating model? But then also thinking through the S, the social. What does that actually mean for your organization? A lot of companies and boards just are interpreting it as meaning how the organization works with charities or works in the community. And maybe that's the right answer, but you really need to think through, well, does our organization have more social responsibility? What is it? How does that affect our strategy? And then the governance part, the G, is particularly difficult. What is it? Is it actually about how you interact with stakeholders, the communication with investors and other stakeholders? How is that actually having an impact on the way you work? But also, does it mean looking at the way the board is working and the board's responsibilities as well? So all we can say here is that it's essential that a board working with management breaks down these 3 components and really makes sure that you understand what it is in your organization and how you're going to use that language. A third step is really to think through what the strategic imperatives and opportunities are. And this is where we see boards working well, is when they've actually integrated their thinking around ESG into the strategy. So they're looking at it not only in terms of how their strategy has to change, but also in a much more positive way, thinking through what are the opportunities for us here? How can we actually get a competitive advantage? How can it really drive innovation? how can it really help us think through new markets? So it's something where say which is built into the strategic thinking, but not just from a what do we have to do to comply. It's very much more useful and valuable if it can actually be what is the opportunity that this new push toward on an emphasis on the environment and society actually helping us achieve. And other elements of that on the strategic side is there's some quite unusual elements to this which make it quite different from normal strategic thinking. What is the social pressure and the political pressure on companies to actually do something, which is quite unusual. But another is the ecological imperatives coming from climate change. This is something which we're all now understanding cannot just be postponed. It's not something we can decide to ignore. This is here, this is happening. We've got to start moving towards net zero. So these things aren't an option. You've just got to think through how it works for you. But also the technology angle. How is that changing what ESG is going to look like over the next 10, 20 years? And it is a very long-term scenario, which also makes it different from a strategic viewpoint. Often companies are used to thinking 3, 5 years from now, possibly in some industries, 10, 20 in the oil and gas industries, for example, or other extractive industries. But usually it's a much shorter timescale. But now this is forcing companies to actually think further ahead in terms of their strategy as governments start setting net zero targets 20 or 30 years out. So it changes the strategic thinking from a timing point of view as well. And I think a lot of boards still have not understood that. They're used to thinking of just delaying those sort of big questions which are too far out to think about. But now you haven't necessarily got a choice. You've got to start thinking much longer term. So the fourth step is connected to the strategy, but it's around this concept of purpose and values. Some of you may be familiar with the push in the UK in the corporate governance rules and codes to really encourage boards to focus on the purpose of the organization. That's not just the strategic goals. This is about why we're here as an organization. What is our responsibility as an organization? What role do we have to play in society? Those sort of big issues. What are we really trying to achieve as an organization socially? And so obviously that the ESG agenda has a lot of consequences for that. But not only that, it's also about the values of the organization, which a lot of companies have been working on and boards have been working on for some years now. And you think, well, a lot of companies will have some stated values and they supposedly are then pushed through the organization, which is great. But now, how does that tie in with ESG? Do we have to reflect our commitment to the environment in our values? And if we don't, is our ESG agenda really going to be taken seriously internally? How do we reflect our social commitments in our values? And for that matter, our governance, what are we committing to in terms of our standards of behavior and ethics, and how are they captured in our values? So it's not just, ESG isn't just something where you end up with an environmental strategy and management go away and apply it. It's a question of how it actually might be changing who we are as an organization, how we behave as an organization, and how do we capture that in the way we describe our purpose and values. So then, of course, it's all very well just the board talking about this and in a board meeting, but it's got to become practical. And so the strategic response has got to be there. And it's really important for the board to understand how management have factored these things into their strategic proposals. And, but also looking at how the strategy is developed, because typically what you would see is management develop a strategy, bring it to the boardroom, it's discussed to the board, and then you move forward from there. but when it gets to the board, the strategy is reasonably well developed. But here, with ESG factors in the strategy, it's quite different because people are having to work through what this actually means. And there are a lot of questions with no answers. And there's a lot of difficult things to forecast. It's very long term. So a bit of a different approach to that strategic planning may be needed, with the board being involved possibly at an earlier stage, or certainly management being willing to bring strategic thinking to the board, which is less developed, less final, because management need help with thinking through the ESG impact as well. So the message here is to really think through, as there's a step here to think through how the board needs to work with management around the strategy now that we're in this different ESG environment. So let's, at this stage, time has moved on and the management has started implementing various strategies. But it's really important that after those initial discussions, ESG does not just become E. So that the environmental social governance does not just become environmental. And we see this happening all of the time. Yeah, it's partly because that's where most of the investor focus is. It's partly because that's where the regulators are pushing, and it's partly where the political focus is. So it's natural in a sense that the environmental gets more attention. But I think it's also because it's easier in a way, because having worked out what all these implications are of climate change for the organization and having identified what the organization is going to do to respond to those, it's easier in a sense to just think in terms of environmental, but it does mean that boards are losing sight of the other aspects. So it's really important that that isn't allowed to happen. So that as step 7, a board should never just assume that the management are
Richard, you muted yourself. I think you hit something wrong. Richard. Yeah.
Okay. I don't know why that keeps happening, but
No,
anyway.
Okay. No worries. So please go back to number 7, please.
Go to number 7.
Yeah. Please.
Okay, number 7. So, yes, I mean, obviously, an organisation can't just assume that what they've agreed, that the board can't just assume that what it's agreed with management is then going to be implemented successfully. The board needs to really get used to watching how the organisation is changing in response to ESG. And this is going to require a new approach. It requires new indicators, but it requires also new questions. As we said before, ESG is all the time affecting many different parts of the organization. It's not just strategic initiatives and projects. It's a way that the actual organization works, how the people work, how the ethics work, as we said before, many different aspects. So the board has got to think through, how are we actually going to get a picture of the way ESG is actually impacting the organization? And of course, that's the question for management. How are they going to help the board understand the way ESG is being driven through the organization? So I'd say it's a question of new indicators, new information, new picture coming through, new discussions, new things on the agenda. So that takes us to the next step, equipping the board to actually exercise oversight. So new reporting, allowing the time to discuss this, not losing focus on something which is possibly quite long term. So you can't just expect the board to talk about ESG and then know what to look for. Management and board working together need to think through how they're going to be given the tools necessary to actually exercise that oversight. Then number 9 is, right, sorry, the color's gone wrong. Anyway, we're on 9 now. So checking what we're saying externally. Okay, so this is a very big driver in the UK. there's a lot of pressure from the investor community, and there's also pressure from the organizations that determine the reporting standards. And as you know, internationally, there's been new reporting standards introduced in relation to reporting on ESG. And for those of you with entities in the European Union, that is going to change even more over the next 12 months. And that become really a very formal requirement in relation to not only reporting, but audit around that reporting. So you really have to understand what it is you're actually saying externally, and then understanding how you're going to really have the confidence that what you're saying is genuinely accurate and reflecting what the organization is really going to do. You will have heard the expression possibly greenwashing, which just is an expression which means organizations who are just saying the right thing about environmental change, but not really changing their behaviors. And a lot of the stakeholder groups involved with this are very sensitive to this greenwashing. And so it's quite a risky area for a lot of organizations, because it's going to be very difficult to, in a sense, get away with that. You're not going to be allowed to just say things and not behave in line with them. So a board has to really understand what is being said externally. What are we actually telling stakeholders we're going to be doing around E, S, and G? Okay, and then really understand how far that is credible. Otherwise, the reputation risk is very high. So just the last step is connected with that, which is this question of really starting to work with a new risk management and assurance framework. And this is particularly for audit committees or audit and risk committees, because they're having to look at how the reporting standards of these sometimes quite qualitative and not quantitative measures are actually being controlled, how reporting is working, what the reporting controls are, but then also the third line, independent assurance over those measures that are being published. So, and this is again something new, although obviously everyone's used to auditing, of course, financial data, and to a degree auditing some non-financial indicators. This is now changing the environment completely, because not only are you actually reporting on some quite different non-financial measures, also these are new systems, these are new things that are being measured, so you don't know how good your systems are or the controls. And the third thing is that it's getting a lot of attention. People are actually looking at this. So you have to be very careful what you're saying and know that what you're saying is accurate. So this introduces a completely new dimension for audit committees. And you can't just wait until it starts happening to you or people start asking questions. You have to plan ahead and really think through, when you're really reporting to these international standards, how you know that your reporting is accurate. So I'm going to stop there. I'm going to close this off. Hopefully that gives you a bit of introduction to just get the conversation started. So Ashraf, please, over to you.
Thank you so much, Richard. Actually, this is very rich presentation. I feel pity that you had to make it so short for the time purposes, but we will share more details with the audience here. Again, one of the points that you mentioned is what does ESG mean for the company, and the boards have to think about this. One of the issues we face here with some of the companies, we do lots of board sessions and trainings and stuff like that. So I recall one of the companies, the boards we met a couple of weeks back, they were saying that, we are sustainable, we have lots of green initiatives, our, company is doing this and this, but we don't feel that this affecting our business that much. Now, if the company feels it's not affecting their business, how can we convince the board that actually this is something important where you have to invest time and you have to invest money in, if they don't feel the direct impact on their financials, if you like?
Well, I think the first question, well, there may not be an impact on the financials at this point. I mean, if they're a listed company, at some point, there may well be an impact on the share value if they're not providing a convincing explanation and following that through with action. But my first question is, have they really thought it through? Because I'll give you an example. I'm a current client of mine is in the software services world. It's a very large global organization, very successful, listed in the UK. And when I first, when they first said, "Oh, ESG," I'm just thinking software services. What's their environmental impact really? But then their director of ESG started explaining, and that was the initial reaction of the management, of the executive team. But then they started looking at not only their building footprint and how their actual buildings are operating in terms of environmental terms, but also their data usage as software solutions providers. And it is huge.
Yeah.
The amount of data they are sharing across many, many different companies, and the energy usage through their servers is enormous. Yeah. So when they actually did that thorough thinking of really following it through across all these different angles, they actually realized that although you wouldn't think this software solution provider would have a big environmental impact, it's actually very significant. And they're now looking at every useful aspect of that in terms of trying to optimize their energy usage. So I think, the question, if they come to the conclusion, oh, we're not sure that it has much impact on our business, I think I would say, well, have a look at, have you really thought it through?
Yeah. Well, actually, I mean, just to echo what you said, I mean, most of the people here, they know that we have been running the Standard & Poor's Hawkama ESG index for the MENA region for more than 10 years now. And we have done some analysis a couple of years back to see whether the companies which are in the index, which are the top ESG companies or compliant companies in the region, are doing really better than the others. And we did really find significant effect on the share price of these companies. So even if you talk about the Middle East stock exchanges, it does make a difference on the share price. And even we did analysis on the ROI as well. And it does make a difference on the return on investment for people who have portfolio of the companies which are ESG compliant. Now, one of the things which we noticed, Richard, in some of the cases we see here in the region is you see companies having an ESG strategy. So they do have a corporate strategy, if you like, but then they have something else called ESG strategy. How common is this practice and how correct is it, if you like, in reality?
It is quite common, in certainly what we see in the UK. I think how much of it is actually ESG, or rather than just the E, environmental, is a different question. I think often it just becomes the environmental strategy. But I think what boards who are really thinking about this are recognizing is that it has to be integrated into the strategy. So in a sense, you need it as a separate statement because that is what the markets, people are expecting to hear about externally. They want to hear what your ESG strategy is. But from an operational delivery point of view, it has to be integrated with the strategy, because otherwise it just runs the risk of becoming something separate. That, it's got to have business benefit, and therefore the business benefit's got to be captured in the strategy. If it doesn't have benefit to the business, it's just going to remain words. So it's got to be integrated in terms of how the organization is actually operating and implementing its strategic plan. So I think the answer to your question is it's got to integrate it, but you probably will need to have something separate because people externally will want to see something like that.
Okay, I see, Habiba, you have a point. Can you say your point, please?
Thank you very much. Richard, thank you very much for that brief narration, that you took us through. As Dr. Ashraf said, that we would have loved to get it more detailed, but I know the time constraint. Again, one of the things that entities are asking today is we are tired of having to develop so many strategies. We have the CSR strategy, we have the sustainability strategy. Now you are asking us for ESG strategies. What would your advice to be to really, as you say, integrated, bring something? What should be a normal, regular, standards ESG strategy look like?
I think it's partly what you start with, because I wouldn't start with ESG. I'd start with the strategy, the corporate strategy. And at each point of the corporate strategy, be asking, what is the ESG angle? Yeah, so that just what naturally becomes the strategy. Yeah, and then later, then if you like, extract the separate ESG strategy. So it's where you start. And I think you're right. There's too many different strategies here. So just think in terms of one strategy, work out how ESG is an integral part of that, and then think in terms of a separate document which explains how you have integrated ESG into the strategy. And then in that explanation becomes the ESG strategy. Does that help?
Yes, thank you very much. It does help. But I think, again, many of the government entities that we deal with, and I know Dr. Ashraf will agree with me, with the environmental angle, everybody is very strong in there, particularly in this region. There's a lot of compliance, there's above compliance, and they are doing it very well. But when it comes to the social angle, they just do not see the value added for them. They understand the internal stakeholders and they know how to deal with the external to the higher standards. But when it comes to external stakeholders, the social angle of it and the social part of it is a completely new area. So what would your advice again be with entities to start step by step? Where should they start? How should they start?
I think one consideration is, in your region, I would imagine that social is almost part of what you do anyway, because my understanding is, often you'll be working in an Islamic environment, and that is part of who you are. I mean, you're very strong social and charitable mindset. So you may not notice that you're doing it in a sense. So, I mean, obviously, Ashraf do comment on this because, of course, I'm looking from outside the region. But it may be a question partly of already just identifying what it is you already do. Mm-hmm. That might actually be your social strategy. It's just that you don't think of it like that because it's just what you do as an organization. So, I think that's important.
But I think, Richard, I think this is quite essential because we need to differentiate in the region between the government institutions and the companies. Now, when government institutions, they do this, it's really pure philanthropy, and even it's more on the PR side than even philanthropy itself. For example, a lot of the CSR budgets in government that goes for sponsoring sports events, for example, and really events which are useless. They don't really add value to anybody, if you like. Rather than even proper, social investment, if you like to call it. However, in companies, it's different stories, because in companies, what we see is, as you mentioned, we see companies doing lots of things. They don't think of it as part of sustainability. I recall one of the big clients we have in Saudi Arabia, for example, they score very low on ESG scores when we, especially the ENS, score when we do the index. And we visited the company for some training for the board of directors, and we spent 2 days there, and we realized they have massive programs for protection for the employees' health and safety, for example, for employees' families, for recycling, for maintaining the environment, for fighting pollution. And they don't even report on any of this. They don't think we should report on that. So companies sometimes are doing, as you mentioned, they think it's natural to do this, so they don't report it. So I think the other side, which maybe you'd like to shed some light on, Richard, is reporting on ESG, because it's something which is very weak in the region, if you are, especially the ENS. So again, G is mandatory, so companies have to report. On the ENS, reporting is quite bad. I mean, do you have any starting points, some recommendations, some observations in this area?
Obviously, you have the standards that are being introduced. There's various different categories or organizations that are setting standards. So that's obviously a starting point. But the danger is that becomes more like a sort of compliance report against standards. And that doesn't typically communicate what it actually means for you strategically. So I like the expression sort of tell the story. And I think too often the people writing annual reports or putting external reporting out think of it as a compliance-driven report, something they're obliged to do, and the language becomes very dry and very formulaic language. And I don't know how many of you are familiar with the expression in English boilerplate, which means very formulaic language, and it's very unconvincing. Okay. Whereas if you actually bring stories alive, then that is much more effective and much more impactful than if you just follow a set framework for reporting. So these can be all sorts of stories. It can be at a very strategic level with the CEO talking about the ESG strategy, but it can also then pick up on stories from across the organization, which can actually communicate what it means to people in your organization. And that can be at various different levels. It can be, I'll give you an example. I work with a very large charity in the UK, which is a cancer-related charity, cancer research. And one of the most effective things I've seen in the boardroom over the last few years, they have a lot of shops which sell secondhand clothes and things on behalf of the charity. And they brought in some people who work in the shops. These are people who volunteer. And they just talked about what it means working with this charity, how they interact with customers, how they feel they're contributing to a very important social role that the organization plays. And just taking those stories brings it to life. And I'm sure all of you across whatever organization you're in could identify a lot of different people, whether they be senior executives or whether they be people working in a branch of a bank or whether they be people working in a factory, who could actually talk about the way that the organization interacts with society. And I think that telling the story and in these individual stories is actually a very impactful, powerful way of really bringing to life what the organization is doing.
I think, Laura, this answers your question, because when you talk about CSR, sometimes it's not really sustainability, it's a different story. So what Richard is talking about is proper sustainability, if you like. So the company, as Habiba said, might have some sort of CSR, which is usually about donations and orphanages and schools and recycling or cleaning the beaches, for example. Like Habiba likes to do this a lot with her volunteers, but that's different from having sustainability for the organization. That's maybe a different story. So I think this answers your question. But Richard, one of the things which you mentioned, which I think again maybe Habiba has witnessed this with us as well, one of the common frameworks used in the region is the Global Compact, and the Global Compact doesn't require any verification of the reports that you are publishing. So, I mean, the idea of greenwashing, how can you handle that? I mean, because if you start saying we need to audit companies on their sustainability reports as well, and to make sure that everything they say there is actually true, this is number one, it's too much work and it's too expensive as well. So how to strike the balance between being pragmatic and preventing greenwashing at the same time, or minimizing it?
It's really difficult. I mean, as I mentioned earlier, the EU is introducing standards which will require a certain level of audit. And of course, if that's required, then it's very difficult to avoid that. But it is going to add a significant costs and audit demands on organizations. And so I don't really know the answer to your question, because some of it is just going to be unavoidable. Organizations are going to have to do it. Depending on what standards they're working to, and you just have to accept the cost. And I think the key thing is to make sure you're getting a business benefit from all of that. So what I mean by that is, okay, so you're looking at how you report on Global Compact or various other standards that are being introduced. You could regard that simply as a burden, a reporting burden and cost, just something which is very frustrating and you have to go through. Or you could look at it and say, well, we've said that these things are actually important to us strategically. So can we actually use this as a way of really making sure that the things that we have said are important strategically are actually being worked through the organization and are actually having an impact on the way that we work? So all the time, you've got to look at these things and say, okay, audit cost, reporting cost, we're stuck with it. We're going to have to do it. So let's look at how we can use it to benefit the business. And I think you have to take that approach, and hopefully you get a positive net benefit from it.
Yeah, hopefully, fingers crossed. And one of the other confusing elements again is the frameworks. So when you tell companies, you need to benchmark yourself in the area of ESG against something, and then now the options are increasing. The number of frameworks which are available for benchmarking. So. And some of them will have like hundreds of variables and factors and so on. Some of them are pretty extensive. So if a company is starting, do they have to benchmark against a specific standard, or they just up to them to decide, or what do you think?
I'm not an expert in this area. I mean, the big four companies tend to be looking very much at this because it's, that actual external reporting is very much their field. But my impression is that there is certainly in the UK, there's they're coalescing around certain standards, but some are more suitable for some industries than others. So I do think you have to look at it and decide which one is going to be most suitable for you. But there again, I think there will be, and this will increase over the next year or two, a coalescence around certain things amongst the investor community. But at the moment, it's really frustrating because obviously you're getting very different messages from different investor groups and different other stakeholder groups. And it is really confusing. What I would suggest as a practical step is talk to your external auditors. And all the external audit firms are spending a lot of time and investing a lot of money in understanding all of this. And they do really understand the technicalities. I don't in the same way.
Yeah.
So just talk to your external auditors, see what they say.
Okay. Habiba, do you usually recommend some sort of, if a government or a company will ask you benchmarking, how can we benchmark ourselves? What do you suggest? What do you do?
Thank you very much, Ashraf. So we always advise the organizations to create a baseline for themselves, whichever line, 3 years back, and then to look in the market of an entity that is in the same line of their business, and to research them thoroughly to see how they are faring against that, and to look as a best practice on the global level, and then to assess where the gap that they have from reaching to that level, and that is where then they start putting their action plan and strategies and to work towards building that. And alhamdulillah, it has helped a lot of organizations really to walk that route, but step by step. I don't believe in overwhelming. I don't believe in finishing everything in one day. It's a process that takes time, and organization need to be convinced with it, and you need to have the buy-in from the internal stakeholders, and that's the most important. So once you get the whole, not only one department, but the whole organization, every department, understanding that and understanding the route ahead, then it becomes a corporate culture, and they start working on it. So we will find us working with an organization, advising them for, slowly but surely. Sometimes it takes 2 years, sometimes it's 3 years, until they are on a very solid foundation and platform.
Well, I like this approach very much, which is actually don't benchmark against some sort of a set of standards, like whatever the standards are, the GRI or ISB or whatever, but actually benchmark against yourself and against your peers in the country, and then maybe a good company or the same sort of activity in an advanced market. So it is really sort of business focused benchmarking, not just standard focused benchmarking.
Because the standards are, the standards, Ashraf, most of the time are theoretical. Group of experts sitting in conference rooms for months and months, developing things that reaches to the level of philosophizing, and not being actually on the ground, understanding the challenges, understanding the reality of the scenario, and dealing with them. But when you are benchmarking against a living and live organization, you are seeing what is happening, and the dynamism of it helps the organization then to be flexible and to work on amending as they see fit, as they move along.
Yeah, that's a very, very pragmatic approach. I love it, actually.
Yeah.
Now, Richard, to go back to the board evaluation then. Now, if we would like to reflect on all this and say, how can we evaluate a board in terms of the level of maturity in handling ESG, if you like? If that's part of the board assessment, how can you do that? I mean, what are the things that you can think of in this area?
Well, working through the 10 steps that I took you through is not a bad approach. I mean, you can't expect organizations to be necessarily all the way through the 10 steps, but I mean, I think you first of all need to look at, have they actually had the discussion of what is ESG? Are they just using this as an acronym, as a term, without really understanding what they mean by it? So that's one thing we look for. Yeah. Another thing we look for is, have they really looked at the extent of the implications of their strategy, and the sort of long list I gave you at the beginning, highlighting all the different areas of the organization that are affected. Has the board actually been through that process of working with management to think through what this actually means? And on those 2 points, I would not score UK boards very highly. I think they're still in a very early stage, fairly immature stage of actually really thinking this through, which is perhaps not surprising. It's a very difficult area. It's not clear, but it does require time. And so one other thing we look at is, how much time are they actually giving to thinking this through? And that often the answer is not enough. Even if if they have a strategy day, for example, you think, oh well, that's probably where they have the time to discuss these things. But often strategy days just become management presentations. Yeah, so they don't spend enough time really thinking it through. And just the last comment is, what I don't like to see is an agenda item, item 5, ESG strategy. But why is it a separate item? It affects everything. It shouldn't be seen as a separate thing you talk about as an agenda item. It's got to be integrated into the way the board is thinking. So that's another thing that we're looking for.
What about actually having it as a department? Because we see this a lot, where a company will have a sustainability department, for example, or a chief sustainability officer. Is this something good or bad? What's your experience with this?
I mean, we do see it quite a lot. I think it depends very much on the person leading it, in the sense that you see some directors of ESG or the sustainability directors who are excellent. I mean, they know that part of their job is to integrate it with the organization and really bring the whole organization with them on the journey, including, of course, the CEO and the executive team. The good ones really understand that. And so the fact that they're sort of a separate department doesn't matter, because the role of that department is to integrate bring the whole organization along. Other ones which are less effective, they sort of are living a little bit in their own world. And that, of course, is not helpful, and that needs to change. And usually it's because the person leading them perhaps just isn't experienced enough, or has been moved from a different department and just given that role without really understanding what it involves. I mean, a way of looking at it, partly, is to look at risk management functions. I mean, a good risk management function in the second line of defense is so integrated into helping the organization improve risk management. The bad ones are the ones who sit there just processing reports and risk registers. So it's that sort of question of how you integrate.
Now you can imagine, of course, the situation if you have a board which does not even discuss sometimes the risk or strategy. I mean, we have seen some of the extreme cases of boards where even the risk and strategy are not even part of the agenda of the board over the year. So I cannot imagine how they can actually discuss ESG in this context, honestly speaking. Type. I have one slide where I need you to give us some sort of more information on, please,
Sure.
which is slide number 4, which is explaining the work out, the strategic implications. I mean, very quickly, the key elements and what the board should discuss in these elements. Just very quickly, because we still have some around 10 minutes or something.
Sure. And obviously, it of course varies from industry to industry. But if you look at the typical strategic factors, I mean, some of it literally is around your production.
Mm.
How is our production going to have to change in order to reduce our emissions, to meet standards, or how is it going to actually adapt to meet our social commitments around communities, for example? So some of it is actually around what you actually do on a day-to-day basis. Some of it, though, is around technology and technological change, because over the next 20, 30 years, if you're going to become a net zero producer, it's likely that your technology strategy is going to have to adapt in order to accommodate that, because otherwise it's going to be very difficult to meet targets. So you've got to think through the technology strategy, but then also the regulatory side of it. Of course, for a bank or an insurance company, you've got two angles. You've got one is your obligations in terms of meeting targets, but also you've got the climate change angle. How is that going to affect the risks that we take as an insurance company or as a bank, for example? Yeah. Then you've got to think through the customer angle, which of course is a key part of strategy. What are your customers going to expect from you? And what responsibility do you have towards your customers? And customers surely must be at the center of your strategy.
Yeah.
So it's a question of taking all of the factors that you would normally consider for your strategy, regulation, technology, innovation, but customers, and thinking through, okay, so what is the ESG, and not just the ESG implications of all of that? So take your typical strategic framework and then work through it.
Now, you mentioned that at maybe at the outset we can have two strategies, one for ESG and one for the company, but then operational wise, they have to be integrated. Now, this integration, is it the job of the management or the job of the board, or they have to do it together? Because that's, again, somebody has to be responsible for this, making sure that we integrate the ESG elements into our operations, if you like. Who does that? Is it the management?
Yeah, I mean, it's not the board's. I mean, the board's job is to oversee and make sure that gets done, not to actually do it. Obviously, that's a bit black and white in the sense that they can help management in the thinking, obviously, and they bring their experience and help them do that. But no, it's very much the management's or responsibility, that integration. So it just needs to become a natural part of the way management think and operate. And that's not going to happen if it's something which they feel is imposed. I mean, Habiba just was talking just now about the need to really get people on board and bring the organization along, and that is key.
And also, I think one of the elements which are essential in this is the KPIs for the management. Because again, as you said, the board will not go down to that operational level to make sure that ESG is integrated in our operations. However, the board should think about KPIs for the management, which are non-financial KPIs that will reflect the board priorities in the area of ESG, if you like. Maybe carbon is one of them, maybe, HR factors, maybe social elements. I'm not sure. Can you suggest any KPIs for the board that they can think of, non-financial KPIs for boards to assess management in ESG?
I think it's beginning to develop. I think you need to, in a sense, look at what's being included, particularly from a remuneration policy point of view. So it's an interesting question for remuneration committees who need to look at executive pay and how they're going to capture those indicators in the reward packages. And it does vary a lot from company to company. I mean, most companies, well, a lot of companies already have health and safety related targets, particularly those who are more exposed to health and safety and fatalities. Obviously, and they are captured in as indicators in performance, individual manager performance review, and also in remuneration. And I suspect it's going to develop along similar lines. But I think it's probably a little bit early. I mean, the remuneration committees we're working with are already now just really beginning to think through how do we do this? How do we reflect it? Because they recognise its importance, but it's very difficult to take it to an individual level. So I think it's a bit premature. I think we need to just wait and see how that develops over the next year or two.
Yeah, I mean, because the key thing is actually, we talk about all these things, but then, the cases which happened, such as Wells Fargo and Barclays before and so on, where when it comes to the idea of compensation and remuneration, it just focuses on the financial targets and that's it.
Yeah.
So you talk about ethics and standards and caring for people and environment, but then when you decide on the package for the CEO and the end of year sort of compensation or reward, it's only about the financials. So if I am a CEO, I would see no incentive for me to waste my time and effort and even reduce my bottom line sometimes to make decisions which will never even affect my remuneration end of the day. So
yeah, so I think that's why remuneration committees have recognized that it is going to be important to include them. It's a question of quite how you include qualitative measures or whether you can actually quantify some of them, which takes us back to this question of control and assurance and the quality of the information that's used, because the last thing you want to do is try and measure things and then have arguments every year on whether or not a target has been achieved. So it is difficult. So we'll see how it develops.
Now, just a final question. We have only a couple of minutes left. A final question is about risk. Now, what are the key risks which companies might face if they don't have proper ESG strategies and behaviors, if you like? What are the key risks there?
Well, one risk is share price related. I mean, it's sort of an external, almost reputation. Well, two things. It's an external risk in the sense that if you cannot communicate and convince your main shareholders that you are actually taking this seriously and acting on it, that your share price will be affected, as you mentioned earlier. I mean, when we talk with boards about the sort of conversations they're having with investors, and that's investors are interested in two main things. One is the ESG strategy, and second is executive remuneration. That is remain the two areas of focus. So, and it is getting so much focus that share price is exposed to that. So that's one reason, but also the reputation risk, particularly on environmental incidents or health fatalities, that sort of thing, of course, is significant. But also, I think the greenwashing related reputation risk is also going to be felt. So those are risks that have to be taken into account. I think the other thing is just in relation to environmental related activity or impact, or for example, the impact on communities. Just generally, stakeholders and the media are just so much more aware. They're so much more sensitive to these things now, that you run a risk if you think you can get away with it, that you think the media aren't going to notice, or that some interest group isn't going to get it into the media, then you're mistaken, because people now, these groups are very clever. They get a lot of support behind them. They're monitoring constantly. And so the risk has increased immensely. And also governments will start acting much more aggressively towards people because the governments themselves face a reputation risk. So it's all just becoming much more sensitized. I think that's the main thing.
Yeah. Well, that was really very comprehensive, Richard. Thank you so much for this very rich information. I really learned a lot from that session. And I'd like to thank you and thank IAL for the partnership. And of course, thank Habiba for her contribution as well. And I'd like to thank